What's up, guys? Jordan here, founder of Relip. And just so you guys have some context, the brokers and lenders on our platform are reviewing and structuring a little over $1 billion a month in investment property deals. And I'm not telling you guys that to brag. I'm telling you that because when you see that much deal flow, you start noticing the same patterns over and over again. You see what works, what falls apart, and ultimately where brokers tend to get confused. One of the biggest areas where I see that confusion is in fix and flip lending. On the surface, it sounds super simple, 90% of purchase, 100% of rehab. But once you actually apply the lender rules like LTC, loan to cost, and ARV after repair value, the picture changes really fast. So today, I want to break it all down for you in plain language. No jargon, no lender speak, just how fix and flip loans really work and how to structure them properly. At the end, I'll walk you through a real example so you can see how this actually plays out in practice. Let's start with why this trips people up. On the surface, fix and flip sounds simple. You'll see marketing that says things like 90% of purchase, 100% of rehab, and it sounds like that's the max leverage, really clean. The lender gives almost all the money and the borrower brings a little bit of cash. But in reality, lenders are not just looking at those headline numbers. Under the hood, you've got loan to cost caps, LTC, ARV caps, ARV, rehab money that comes out in draws instead of all at once. And then on top of that, some lenders are now looking at the borrower's actual return and liquidity. So the headline is simple. The rules underneath are not. This presentation is about making those rules feel obvious so you can structure deals correctly every single time. First big idea, fix and flip loans are asset-based. That means lenders care a lot more about the deal than about the borrower's W-2 income. They want to know, what's the property worth now? What will it be worth after the renovation? How big is the rehab budget, and does it even make sense? How experienced is the investor? And do they have enough liquidity to actually finish the project? Now, credit matters, but it's not the main factor. Once you internalize that these are asset-based loans, the rest of the rules start to make a lot more sense. There are basically 4 rules every fix and flip lender uses. Once these 4 click, the whole business stops being confusing. Rule number 1 is loan to purchase, or LTP. And that's just how much of the purchase price the lender will fund at closing. Rule number 2 is rehab funding. How much of the rehab budget they're willing to finance, usually in draws. Rule number 3 is loan to cost, or LTC, which caps the entire loan relative to the total cost plus the rehab. And rule number 4 is loan to ARV, or loan to after repair value, which is the leverage based on the after repair value. Most lenders land around 65 to 75% of ARV. In any real deal, all 4 of these are running at the same time. But let's unpack these one by one. Rule number 1, loan to purchase. It's the easy one. If a lender goes up to 90% purchase, that means that the borrower brings 10% down at closing. So on a $300,000 purchase, the lender does $270,000. The borrower brings $30,000. The important thing to understand is this only controls the amount of money that shows up at closing for the purchase. It does not cap the total loan for the whole project. This is where a lot of people stop thinking. They hear 90% of purchase and assume the rest of the math will just work out. It doesn't. The other rules still have to approve the full loan amount. Rule number 2 is rehab funding. You'll often see up to 100% of rehab in market. And that sounds like the lender is just cutting a check for the entire renovation budget on day one. That's not how it works. In reality, rehab funds are held back and released in draws as the work gets completed and inspected. So you can think of it as two buckets. Bucket one is purchase money at closing controlled by LTP, loan to purchase. Bucket two is rehab money, which comes out over time as the project progresses. And that's important because the borrower usually has to front some costs between draws. And remember, whatever the lender is promising on rehab still has to fit under the LTC and ARV caps we're about to talk through. Rule number 3 is loan to cost, or LTC. And this is where things get real. LTC looks at the total project cost, the purchase plus the rehab, and says, we will only go up to this percentage of the total cost. So if, let's say, our imaginary investor, Bob, is buying for 300 and putting in 100 to renovate it, the total cost of the project is 400. At 80% LTC, the lender is saying the maximum total loan we'll ever do on this deal is $320,000. That 320 includes both the purchase money and the rehab money together. So even if the headline says 90% of purchase and 100% of rehab, the LTC cap can quietly pull that total amount back down. Rule number 4 is loan to ARV, or after repair value. The ARV is what the property should reasonably be worth once the renovations are complete, based on actual comps. Most lenders will sit somewhere around 65 to 75% of that ARV. So if the ARV is 500,000 and the lender goes to 70% of ARV, the max total loan by this rule is 350,000. But here's the key. Lenders are going to use their ARV, not the borrower's optimistic number, the ARV that appears on the actual appraisal. So if your investor thinks it's, 550, but the comps say it's 500, the lender is going to underwrite off of the real number. Let's make it concrete with a simple example. Say your borrower, Bob, is looking at a property for 300,000. He wants to put 100,000 into the renovation, so total cost will be 400. Based on comps, he thinks the ARV is around 500,000. The lender's headline terms say 90% purchase plus 100% rehab, 80% loan to cost, and 70% ARV. A lot of brokers look at that and think, all right, 90% of 300 is 270 plus the full 100 for rehab, so the loan will be 370. But now we know that's not how it actually works. So we're going to have to apply the LTC and ARV rules for the deal. And here's what really happens on Bob's deal. We start with the LTC. The total cost is 400. LTC cap is 80%. So the maximum total loan by this rule is 320,000. That's the first hard ceiling. Then we check ARV. 70% of a 500,000 ARV is 350,000. So by the ARV rule alone, you could go up to 350. But lenders don't pick the biggest number, they pick the lowest cap. In this case, LTC is 320 and tighter than the ARV at 350. So the real maximum total loan is 320,000. Inside that 320, the lender might still give Bob 270 at closing, but that only leaves Bob about 50,000 of rehab that they can actually fund. The rest of the rehab has to come from Bob's cash. So this deal is not really 90% of purchase and 100% of rehab. Once you run the actual numbers, it behaves more like 90% of purchase and 50% of rehab. And by the way, you could always flip those numbers. We can reduce the initial amount of purchase and add money to the rehab. And that will largely be dictated by how much experience the borrower has and if the investor is comfortable giving more upfront, right? The holdback is designed to mitigate against risk for the lender because, hey, what if the borrower doesn't complete the project? And so we want to put or typically lenders want to put as much money into the holdback as possible because there's a draw system. We only release those funds once we've seen, okay, the borrower's added the windows, the scope of work for the project says the borrower wanted to put 20K in the windows. And so I rather wait to see windows installed to give the borrower the funds for the rehab of the windows, as opposed to giving it to them up front, and it's more risky for us. Now, here's another thing brokers miss, and this is becoming a bigger deal with a lot of lenders. Some lenders also look at the borrower's actual return, basically the cash on cash return on investment that the borrower makes on his money. Think about what Bob is actually tying up: his down payment, closing costs, his interest-only payments during the loan, let's call it 9%, insurance, taxes, utilities, and all the other carrying costs for the project. After all of that, that's the actual profit relative to the cash that he had to put in. How much profit did he make relative to the money that he put into the deal? A lot of lenders want to see something like a 20% cash on cash return for the borrower. So if Bob is tying up 50 or 60 grand of his own money, but the projected profit is $8,000 or $10,000, that's not a very strong deal. Many lenders won't fund a deal where the borrower's return is that weak, even if the leverage technically works. So it's not just can the lender do it, it's also should the borrower do it? So how do you structure a fix and flip correctly every single time? Well, step one is validate the after repair value. If the borrower thinks after repair value is higher than what the comps support, the lender is going to use the real number, not the optimistic one. Step two is validate the rehab budget. Does it make sense? Is anything missing? Is the cost realistic for the scope? Step three is calculate the total cost. Purchase plus rehab. That's your all-in basis. Step four is run all the leverage rules: purchase advance, rehab funding, LTC, and ARV. Whichever number is lowest becomes the real maximum loan amount. And step five, check liquidity and cash on cash. Even if the leverage works, the borrower still needs enough cash to close, carry the project, and produce a meaningful return. If you run this checklist on every deal, lender feedback stops being surprising. You know what the deal looks like, how much profit the borrower can ultimately make, what his returns are, if he's being reasonable, if the project is completely in disarray, the property had a fire, or there's barely walls up. Does it make sense that it's only a 50K budget, or does the property need way more than what the borrower is anticipating? These are all things you need to think about when you're evaluating a project, in addition to just the numbers and the rules themselves. Now, you can absolutely run this whole playbook in spreadsheets and on the back of a napkin. A lot of people do. The problem is, every time a number changes, you're rerunning LTC, rerunning ARV, double-checking rehab, and trying not to forget about liquidity and cash on cash. It's doable, but it doesn't scale, and it's easy to miss things. Relip is built to handle that logic for you. Our platform encodes the real lender rules, purchase advance, rehab draws, LTC, ARV, and runs ROI and liquidity checks in the background. So instead of guessing what a lender might do, you're structuring deals the way lenders actually think at scale. All right, that is the real version of fix and flip lending. Once you understand these constraints, loan to purchase, rehab funding, LTC, ARV, experience, and ROI, You can structure these deals correctly every single time. You protect your borrowers from bad projects, and you send lenders files that already live inside their box. If you want more breakdowns like this, let us know in the comments. And if you want a tool that basically handles all of this logic for you, that's exactly what Relip is built to do. Thanks for watching, and I'll see you guys in the next one.